How next month's actuarial report to Congress on the reverse mortgage may influence which HECM reforms are enacted and which ones are not. While we've seen no official mortgagee letter or congressional action on recent proposals to reform the federally insured reverse mortgage program, or the HECM, there were some key changes that were restated just last week by HUD Secretary Ben Carson in his written remarks to the House Financial Services Committee. Major legislative proposals, such as the outright elimination of the national lending limit for the reverse mortgage and the removal of the program from FHA's Mutual Mortgage Insurance Fund, those may hinge on next month's report to Congress, and that report will detail the financial health of the program. However, the potential elimination of all HECM to HECM refinances could be enacted outside of Congress by the Federal Housing Administration. That would be an administrative change that does not require any legislative approval. And while it is being opposed by key industry stakeholders, it could be held forth to lawmakers as confirmation of the agency's continued commitment to the financial stewardship of the program, especially if next month's report reveals increasing financial liabilities. Now, truth be told, recent fiscal year insurance claims give us little insight as to how effective previous policy changes may have been. So think of a moment just of the reverse mortgage program's financial liabilities as a large and long river. Notable incidents upstream will not be felt or seen for several years later when a substantial portion or a cohort of those loans written at that time are terminated. And just as a thunderstorm upstream may produce a flash flood, the crash in housing values a decade ago and the full draw fixed rate HECMs that followed are now being manifested in increasing and continued HECM claims. Simply put, regardless of how effective recent reforms, such as the financial assessment or first-year distribution restrictions may be, their significance will be lagging after their implementation. But there is an upside, as the problematic cohort of those loans will eventually subside from a torrent to a trickle, and future liabilities from loans in the housing market's recovery will actually make it pale in comparison to previous years. In the days after the release of the November 2018 HECM Actuarial Report, the reverse mortgage community anticipated continued cutbacks in PLFs. But what may have spared us an additional cut were the remarks of FHA Commissioner Bryant Montgomery himself. Now, at that time, he did acknowledge the significance of continued insurance claims from HECM loans, but he also said there was an optimistic outlook for the program with continued improvement from the reforms that had been enacted before. And the result was the second appraisal rule, and it was a change that was unwelcome by most, but it was less likely to impact HECM accessibility and loan volume than a PLF cut. Federal housing programs are no stranger to repeated deficits and program losses, and neither are they immune from politics. And while the waters of previous reverse mortgage loans are passing under our feet today, the flow of future losses have been significantly diminished. While the source of mounting insurance claims will eventually be water under the bridge, as they say, they will continue to be shaping policy making and ultimately the accessibility of the HECM program for future generations of older homeowners. Now, what are your thoughts on the potential impact of the actuarial report next month? You can leave your comments below. And also, if you'd share this video with other reverse mortgage professionals using the social media links on this page, you can do that on your Facebook and LinkedIn timelines. Thanks again for watching and have a great week.